My name's Edward Anderson, and I am the host, moderator, and all-around nice guy of the Hey Ed YouTube channel. I am not a financial advisor, nor do I play one on TV. This video is for entertainment and educational purposes only. Okay, so in this video, we're going to talk about what happened on Thursday and Friday of this week in the market and how that affects you. How did that affect all of us? I'm going to tell you exactly why it happened and give you the whole picture. Okay, so in my last video, I showed you where the critical support level was on this market. And I told you that the market was going to go down and it had a lot further to go before all was said and done. We were going to end a protracted period of downside movement in this market. And what happened the very next day on Thursday? The market gapped down and then went as low as it was over 600 points down right away early in the day. And then it started to rally. And then by the end of the day, it recovered all of its losses. And then the following day, on Friday, the market was up 800 points. Okay, so what is going on? I'm going to tell you exactly what's going on. Okay, now remember, the reason why the market's been soft lately is that the Federal Reserve has been making noises about starting to raise interest rates and abandoning, well, not abandoning, but moving away from its quantitative easing policy that's been on for a few years. So a couple of charts ago, I showed you the past 2 years, the Federal Reserve has given the market a sugar high. Now, keep in mind that when interest rates are low, people have to search for yield somewhere else. They can't live off of their 1%, from the bank account. So they have to go places. So it goes into the stock market and it goes into other financial vehicles. So that's what I mean by the Federal Reserve has propped up this market. People poured money in the market not because they wanted to, but because they had to, because the Federal Reserve has been shooting financial heroin into the veins of the street. Okay, this is not a natural move in the market. Now that they are starting to raise rates, okay, now some really ugly things are going on. And the Federal Reserve's mandate is to keep inflation under control. And they've stated they want to keep their inflation to 2% or lower. And the past few years, they've been getting away with it. But now the chickens are coming home to roost, and they're going to have to start raising rates if they're going to fight inflation. Well, if inflation is running at, let's call it 7.5%. If inflation is 7.5%, in order to fight it efficiently, they've got to get interest rates up to 7.5% or better to keep our buying power at even. And they know how the street's going to react. The street is not going to like it because the Federal Reserve is taking away the punch bowl. Okay, the party is over, so to speak. Wall Street doesn't like that. They've been living on freebies for a long time. And so any idea of the party being over is going to upset Wall Street. So when they just started making noises about raising interest rates just 0.5%, 50 basis points in the month of March, Wall Street started to panic. What? You're going to raise interest rates 0.5%? Oh my God. And so the markets got really nervous. All right. And then what happens? Thursday comes along and the market gaps down on news what's going on in Russia and Ukraine. And Biden had his speech announced. And they're expecting some really draconian measures. We're gonna pose a lot of really punishing things on Russia. And the net effect is it's going to hurt us as well. Well, then Biden came out and he was actually kind of a weak need. It was a weak need response. So ironically, because our president doesn't have a spine, Wall Street said, oh, thank God. We were expecting worse announcements about sanctions and all the rest of it coming out of the president. Instead, the things he's going to do are not that bad. Remember, Wall Street is profit-centric. They just want to make money. Okay, so the market gapped down on expected really draconian news out of the White House. Instead, it wasn't that bad, wasn't that serious. So Wall Street said, well, hey, you know what? That's not so bad. And so bargain hunting came in. Now, also on their minds was the idea that the Federal Reserve now has a new little shiny object for people to focus on, right? They're focusing on world events. And so now they can say, you know what, the economy is bad because of them. They're the bad guy, not because we were incompetent, not because we didn't know what we were doing, not because we were printing money like it was going out of style. It's because of those guys. And so the Federal Reserve might not be raising interest rates by 50 basis points like they were making noises about for March. Instead, it might only be 25 basis points. Okay, so that's what the Wall Street wants. Remember, Wall Street wants lower rates. Anything contrary to that is negative news. So when the Federal Reserve has an excuse to keep the party going, okay, Wall Street likes that. Now, here's the problem with all of that, okay? It's a pay me now or pay me later scenario. As I spoke about before on my channel, the Federal Reserve is in a really tight spot because at some point, they are going to have to raise interest rates. And if they're going to be serious about fighting inflation, they're going to have to raise them a lot. Anything short of that is going to lead to hyperinflation, okay? And if they do raise rates too dramatically, we're going to be heading into an actual full-on depression, okay? So it's a really tight spot the Federal Reserve has put all of us in. By the way, a little unfun fact, 40% of all US dollars in existence, both digital and physical, were created in the past 2 years alone. That's how ridiculous it has gotten. And that is why the value of your dollars are going down rapidly. All right, so what does all this mean for us? So we saw the market gap down on Thursday and then gain it all back, and then the next day have an 800-point run. Why did that happen? Well, I told you about the first part. Okay, it gapped down on expectations that the news out of the White House were going to be draconian, but instead the news wasn't that bad. Wall Street said, you know what, he's not going to get that tough. So people breathed a sigh of relief, and the market started to rally. And then on Friday, so why did we have the 800-point move on Friday? Well, there's a little thing called shorting in the market. Now, shorting, for those of you who don't know, is a way of making money on things when they go down. So the formula for making money on anything is always the same. Buy low, sell high, right? Well, when you short something, you're doing that in reverse. First, you sell, and then you buy back at a lower price for the profits. That's the intention, right? And right now you're saying, well, how can I sell something that I don't own? Well, look, for now, just trust me that you can do it. And that's what shorting is. And that, if you watch the movie, The Big Short, okay, they explain all of that to you. Now, shorts, they make money the opposite way of people who are long a stock. Long means you buy low and sell high, right? If you're long a stock, that means you want your stock to go up, and that's how you make your money. If you're short a stock, you want it to go down, and that's how you make your money. Well, it's also reversed for losing money. Okay, if you own a stock and it goes down, you're losing money. But if you're short a stock and it goes up, you're losing money. And shorts tend to be short-term money, right? That's just the nature of the beast. Shorts don't like to hold stocks into a weekend. So it's a Friday. They didn't want to take the risk that something would happen over the weekend when they're not in the markets, right? So they don't want to take the risk of holding their positions, over the weekend. So they're covering their shorts. That means they're buying back the stock, right? They're closing out their positions. So a combination of people doing their regular buying, their regular bargain hunting, you have the shorts who are covering. So that's a double whammy. And that created what we call a short squeeze. And short squeezes can be very dramatic. Okay, so what does this mean going forward then? Well, first of all, it means expect a lot more volatility. Now, volatility is wonderful. If your traders love volatility, okay, because that's how traders can make the money. If you're a trader and you know what you're doing and you're disciplined, you can make a lot of money when in a volatile market. But if you're an investor, you're going to be really frustrated because you're going to go day by day with emotional extremes. On one day, you're going to be relieved, and then the next day, you're going to be depressed. We're going to be in a very volatile market for a long period of time here, and the market's going to turn around. We're going to have days with massive sell-offs, days with rebound rallies, but the trend is going to be down. So what should you be doing? Well, like I mentioned in the other videos, First, you do want to reduce your exposure to the banks because when there is a run in the bank, and there are going to be runs in the bank at some point, a financial crisis is going to kick in. So start reducing your exposure to your bank. What I mean by that is get your dollars out of the bank physically. But then you still have the physical dollars, which are a depreciating asset all by themselves. So I would keep some on hand, just to have cash on hand, and then put a bunch into silver and gold. And the next thing you want to do is you want to start establishing passive recurring income. And the program that I'm in, that I've alluded to several times in my channel, and I can't mention that program by name on YouTube. There are rules against it. But if you contact me individually, I'll be happy to share information on that program. But in that program, I get 3x, and I'm not exposed to market conditions. And it's a spectacular program, and I'll be happy to describe it to you. And so whether it's the program that I'm in or a different kind of passive income, it's really important to start developing sources of passive recurring income. That's income that you're not working for, and that it's always coming in, okay? And I can show you a couple ideas, including the main program that that I'm in. So the important thing on the charts, from what I can see, is that that critical support line was broken. The fact that it rallied a little bit above that support line, on Friday, I think that's just a pushback rally. And as things develop here in the near future, they're going to go down. Now, there are two things that could make the market rally from here. The first one was if the president woke up one morning to discover that he actually grew a spine overnight and decided to go ahead and reverse his executive order on the Keystone Pipeline and extend the leases to drill oil on federal lands. Okay, the market will rally. Even though it's going to take a while for the oil to start flowing, Wall Street always looks down the road, right? So the market will rally because the prices of gasoline will come down. If he truly is going to honor his word about doing everything he can to relieve the pressure for us, that's a no-brainer. Just reverse your policy on energy development in this country. Now, I don't think he will do that because I don't think he has the moral courage to stand up with the liberal part of his party. So if he made that announcement, the market would rally, on that. Okay. And another thing would be is if peace broke out in Ukraine, okay, that would make the market rally. So there are a couple of things that would make the market rally from here, at least short term. But then we're longer term, medium to longer term, we still have other issues related to inflation and the financial policies of our government. So this is going to be a very interesting summer, and I think you want to get prepared for it. But in my case, I don't really care what the market does because of my passive recurring income, the program that I'm in. I'm immune to all of this, which is what you want to be. You want to be in a position where you personally should not have to care about what the markets are doing because you're covered. You took the right steps. 3 simple steps, and biggest one being developing passive recurring income. Contact me. My contact information will be in the description below, and I can send you some information on that program I'm in. Everett Anderson signing out.
Copy that.